Imagine this, it's 2009. Your friend tells you about this small finance company called Bajaj Finance. The stock is trading at 30 rupees. You are skeptical, but he insists it's the next big thing. Fast forward to 2024, that same stock is worth over 7,000 rupees. So 1 lakh investment would have grown to over 2.3 crores. Well, that's what we call multi-bagger stock. Hello and welcome to our channel 5 Minute Finance by ET Money, where we discuss the basics of investing and personal finance. This video is going to be all about the basics of picking multi-bagger stocks. So let's get started with the basics. A multi-bagger stock multiplies your initial investment several times over. The term was coined by legendary investor Peter Lynch. For example, if a stock doubles your money, it's a 2-bagger. If it grows 10 times, it's a 10-bagger, and so on. These stocks usually belong to rapidly growing companies. They might be in new booming industries or have found innovative ways to succeed in established sectors. Think of companies like Infosys in the 1990s or more recently Bajaj Finance. These companies saw their stock prices skyrocket over the years, turning many ordinary investors into crorepati's. But how do you find such gems in the stock market? It's not just luck. It's about smart analysis and informed decisions. So let's explore how you can identify multi-bagger stocks. We have broken this down into 5 crucial factors. Nothing better than starting with looking at the numbers. A company's financials can give you a clear picture of its health. Few things that you should focus on are increasing revenue and profits. You want companies with steady revenue growth and profits. Steady sales growth means expanding market share, while rising profits indicate efficient cost management. Consistent upward trends like these could mean you are looking at a future multi-bagger. Next is comfortable debt to equity ratio. Check the company's debt levels. A high debt to equity ratio can be risky, making it tough for the company to repay. Ideally, look for companies with low or manageable debt. While this ratio varies across industries, aim for it to be below 0.3 for a safer bet. Then we have high return on equity, ROE, and return on capital, ROC. The return on equity and return on capital ratios indicate how efficiently a company is using its resources. Higher ROE and higher ROC signal smart capital use. Take Asian Paints as an example. It has managed a 15% plus ROE for over 2 decades. That's the kind of consistency you want. Next is consistent EPS growth. Consistent growth in EPS, earning per share, is another strong indicator of a company's profitability and future potential. Companies with rising EPS often see their stock prices grow in tandem, driving wealth creation for investors. And last, we should look at the price to earnings, PE ratio. Now, while the PE ratio metric doesn't give the complete picture, it helps to compare how a company's stock price relates to its earnings. A high PE may mean overvaluation, while a low PE could signal a buying chance. Plus, observing the growth of the PE over time shows how a stock's value has evolved. Take the example of HUL's growth. Between 2006 and 2021, HUL's share price grew at 17% CAGR, outpacing its EPS growth of 11%, revealing a 6% gap. A look at the PE ratio helps explain this. Now, between 2007 and 2011, it ranged from 25 to 35, but surged to 45 to 55 from 2012 to 2017, and now sits between 60 to 75 since 2018. This rising PE reflects the company's growing value and contribution to shareholder wealth, emphasizing how PE growth drives stock price increases. To understand price to earnings ratio in detail, you may watch our other videos. The links are in the description. Next, let's move to the second crucial factor. So let's look at some qualitative aspects. One key factor is a company's competitive edge. What sets it apart from rivals? Think of it as the moat around a castle, protecting the business from competition. This economic moat can take many forms, like strong brand recognition, patents, or a cost advantage. Like we have Pidilite Industries, maker of Fevicol. It has built such strong brand recognition that Fevicol is now synonymous with adhesives in India. That's a moat. In today's market, companies must continuously widen this competitive edge to sustain long-term growth and success. Now, innovation is crucial for growth, especially in competitive markets. Take Tata Group's retail company Trent, for instance. Recently, the company has expanded into areas like food, grocery, and footwear. This diversification has significantly paid off. Over the last 5 years, Trent has delivered over 1400% returns, with its revenue almost quadrupling and profits rising 7 times. It also had the highest revenue growth in the entire consumer discretionary and retail space, beating well-known names like Shoppers Stop and D-Mart. Companies that embrace innovation and diversification like Trent create new opportunities that can lead to long-term growth and increased stock value. Now, as Warren Buffett says, price is what you pay, value is what you get. Even if a company shows strong growth, buying at the right price is the key. If you overpay, you might have to wait for a long time for your investments to grow. Take the PSU sector for example. From financial year 2020 to December 2023, profits surged with the rally starting around April 2020, right after the COVID-19 crash. Profits grew over 4 times, driven by cost cuts and improved margins. So if you had spotted this sector early, you could have ridden the rally and gained from that growth. Good management is crucial. Even the best businesses can struggle without it. Take Satyam Computers for example. In 2009, it was a leading name in the India's IT sector until its founder confessed to a 7,000 crore fraud, causing the stock to crash 90% in a day and wiping out investors' wealth. That's why it's important to look for management teams with skin in the game, where owners are actively involved and committed. Companies like Reliance, Tata Group, Wipro, and Dr. Reddy's have succeeded because their leaders make smart decisions on spending, strategy, and cash flow. Strong management focuses on transparency and creating value for shareholders, driving long-term growth. Now, finding multi-bagger stocks takes time. They don't grow overnight. That's why patience is the key. Focus on companies with strong financials, competitive advantage, innovation, fair valuations, and excellent management. With patience and persistence, even a single multi-bagger can make a remarkable difference to your financial future. And it's a wrap. We hope you liked this video. If you liked it, please do share and subscribe to our channel, and we'll be back with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.